everyone. Today we are looking at capital. That is our next topic, capital. Capital, that's our next topic. I would like you to recollect where we stop. Don't forget that this term we started from warehousing. That was the first topic. And I want you to always lay them to heart because I told you, if you remember very well, that topics like this, your class, SS1, majorly there are those things that WAEC and NECO, all those examination bodies, they like to bring out. You understand? So I think I also share a scenario with you where what I thought maybe your class or grade 10, they just came out in the last commas they did. You understand? The question came out in the last one they did. Just imagine that. So, and what are those things? Sometimes when you're looking at the spectaculars, looking at, they may ask me this, they may ask that, don't be surprised that they might not ask you questions up to that. And even if they're going to ask you questions, it may not be, it may be where you are least expected. So each of the topics that you come across in commerce, make sure you take them serious, please. We look at the warehousing, then we move to the history of Nigerian capital market. I told you that the financial institution is divided into two, or the financial market. We have the capital market as well as the money market. So we look at what takes place in these two markets. You understand? We focus more on the capital market. So that is where we get long-term finances. Long-term finances, that is where investors, they meet together with the provider. The investors are the provider of the finances, while those that need the finances, they will also come to meet. You understand? So we look at the history. We look at some of the regulations, that actually led into the establishment of the capital market. We look at the ISA, the ISA recommendation. We look at other revolution that's taking place rather in this market previously. So today, okay, before we go to that, that leads us to another topic where we have the the stock exchange market. And I told you that the stock exchange market is what you know as the first tier market. And we look at it that only companies that have been quoted, and I mean that quoted means that those companies which are listed, those that have made the registration of being, on the stock exchange market. And what does that mean? Being on the stock exchange market means that their shares are open for public subscription. And what is the meaning of public subscription? It means that they can appeal to members of the public to buy from their shares. You understand? And buying from their shares also means that what? Those that are buying from their shares become the shareholders of that company. You understand what I'm saying? So we talk about the stock exchange market. And I said the first stock exchange market was established and is located where? In this Lagos as Nigeria Stock Exchange Market. If not for this pandemic, I believe by now you should have gone for excursion at the Nigeria Stock Exchange Market. You understand, so that you will see what we're actually talking about. And perhaps then you might even be inspired to be to work in that market, because stock exchange market is an organized market. I can remember I also asked you in that class that you should define market. One of you said market is a place where we buy things. Someone said market is a place where we buy things and so on and so forth. And I also remember I told you that when you are defining market, there are very varying point of view. For example, you look at the market from the point of view of an economist. You look at it from the point of view of the accountant. You look at it from the point of view of the socialist. You even look at it from the point of view of a politician. You understand what I'm saying? So markets in that context, it depends on the context with which you want to explain it or you want to define it. I think we are together. So when we talk about markets here now, we're not talking about market as a place where we buy, maybe we buy, those commodities, fish, melon, pepper and all those ones. Those ones are called commodity market because I need you to understand what that concept means. So market itself, is not just a place where we buy goods. The one that where we buy goods that are feasible or goods that we can heat or that we can use at home, maybe kitchen utensils and all that. Those ones are called commodity market. You understand? But in this concept or in this talk, I said the stock exchange market is not a place where we buy physical goods. What we do in the stock exchange market is to trade in financial securities. And when we talk about financial securities, we are talking about what? We are talking about things like items like, we're talking about items like stock, shares, bond, debentures, all those ones are called financial instruments, financial securities. They are so called financial instruments because, they secure the assets. They can help secure the asset of what? Of an entity. And I think if you could recollect, I said that, when we talk about security, from the point of view of the business or from the point of view of an organization, we are not talking about those that are staying at the entrance of or maybe those that are staying at the security post. We are talking about any financial instrument that can secure our assets. I believe you know what I mean by assets. Good. Assets, these are things owned by the company that generate income. You understand? They generate income. They can be fixed assets, they can be current assets, they can be, prestigious assets, and so on and so forth. Now, we're not going to that. So the stock exchange market, we also look at what are the importance of stock exchange market. And I said that it provides a place where governments, where investors can multiply their fund. You understand? It is also a place where government can raise revenue. You understand? So I also explained that is a place that is a kind of forum that brings the owners of capital together with who? Together with the company that needs this capital. All right. That has to do with the stock exchange market. I'm trying to do a kind of recap because of so that it can help you. You should have all these topics in your default. You understand? So that when anybody wakes you up, that wake up, boy, what is this? What is that? You understand? So we look at the importance and the significance of stock exchange. I also said that it is important to the economy. Why is it important to the economy? Because sometimes when we look at the data or the data from the stock exchange market, from the international view, we can look at, okay, in this economy of, let's say, Nigeria, how many companies are listed on the stock exchange market? What is their performances and this and that? We have so many yardsticks to that. All right. The last topic, that's last week topic, I think. That's when we discuss the second tier security, the second tier security market. I believe you can still remember. And I said that this is a market where companies that do not meet up with the registration or with the requirement of the stock exchange market where they are listed, or where they also meet to be able to raise capital. I would like you to understand this very clearly, because your stock exchange market is different from your second tier security market. Second tier security market. The first tier market is your stock exchange market. And it is so called first tier market because it is where companies, firms that are registered and are listed. What I mean by listed, they must have met the requirement. You understand what I'm saying? We have the procedures and the requirement for that. For example, one of the procedures is that the company that will be listed on the stock exchange market has to submit their audited financial statement for 5 years. That's one of the requirements. Audited financial statement for 5 years. You understand? They have to submit it. And you know what I mean by audited? It has to be audited by the who? By the by the auditor, among other requirements. You understand? So those companies, there are some companies that will not be able. For example, the company that is just starting, how maybe just spend 2-3 years or maybe a year, and they want to be listed on the stock exchange market, having realized the opportunity that is, that can be tapped from the stock exchange market. So they will not be able to take this privilege. So what will they do? They have to go through the second tier market, or maybe shares of companies that do not sell. I think I can recollect that I asked you this question that last class. If you can also recollect as well, I asked you that you give me the shares of a company in Nigeria that is like, how can I put it? Is something that is like hot cake. It's like something very, 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 very attractive. That once they say, okay, we are giving out this stock with these shares, people will start buying it without even thinking of anything. And I think someone mentioned what MTN. The MTN. I said, wow, that's correct. If MTN should say, okay, we are giving 200,000 shares open for public subscription today, people will rush to buy. Why? Because of the prospect of the business. You understand? Because of the prospect, because of what they are made for. You understand what I'm saying? So we're still coming to that. We're still coming to that. Now, and there are some companies in Nigeria, that when they mention that, okay, we are selling our shares, people will not like to even go there. Even if you hear, people will even hear who is going to buy that share. For example, all these electricity companies that we have in Nigeria now. Imagine one of them now say, okay, we are open for public subscription. Come and buy the shares worth 100,000. So it's now open at 0.50 kobo per share, this and that. At the end of the day, only God knows how much they're going to sell it. You understand what I'm saying? If 0.50 kobo or 50 kobo is the per value of the shares, you understand what happened? People may not want to buy. Do you know why? Because of their prospects. So such company is not their fault. You understand what I'm saying? It's the economy and the sector they find themselves and the kind of people they are relating with in this country. You understand what I'm saying? So these kind of companies, if they want to get or raise fund and they cannot go through the stock exchange, they go through the secondary security market. I believe that one is clear. So we also look at the requirements for what? For the enlistment, for the admission of companies into the stock exchange, into the second tier security market. We look at that, and I think part of those things that we mentioned is that before a company can be listed on the second tier security market, it must satisfy the following requirement or conditions. I say number one, the company must be incorporated as a public limited company. Yes, it must be a public limited company. That's it. It must not be a private limited company. Then the shareholder must not be less than 100. The shareholder of that company that must not be less than 100. Three, the company must sign a general undertaking with the stock exchange market. What does that mean? The undertaking should be a form of MOU, memorandum of understanding, that see, we have these social companies that has been listed with us. You understand? Because they are more or less like a sister or a brother to the stock exchange market. You understand? Then the company must make available at least 10% of its equity share to the investing public. I said that what this means is that if you are making 10% of your equity, it means that, let's say, we're going to talk about capital very shortly. I'm just trying to give you a kind of building background on what we have learned so far. You understand? So that there can be consistency in our discussion. Thank you. All right. The 10% of its equity means that, always each firm or company, they always have their issued capital. And what we mean by this issue capital means the amount from the authorized capital that they can issue to member of the public for subscription. So it should be 10%. Let's say the amount they are using to do their business is 1 million. 10% of 1 million is what? Okay, 100,000. Very good. So it means that 10% of that means 100,000 should be for public subscription, the amount of shares that people can buy. Another thing that is very, very important is that the 3-year financial statement. Can you see that? I mentioned 5 years earlier. You understand? 3 years financial statement of the company must be submitted to the stock exchange. It's not just financial statement, but audited financial statement. Do you know why? They need to do a kind of performance appraisal to really understand their performances or the performances of these firms that want to be listed in the second tier security market, for those years. The stock exchange is always 5 years. That one, there's no nothing. The rule say that they must submit their what? The financial statement for 5 years, or the financial statement for 5 years. But for secondary security market, it has to be 3 years. Another thing that is very important is that the investor, any investor or shareholder, is not allowed to acquire directly or indirectly more than 75% of the issue capital. For example, a company is issuing 100,000 shares. Nobody should take 75,000 shares. It's not allowed. That share, the number of shares has to be among who? Among the shareholders. It's not that, oh, well, because I'm very rich, all right, I have to take the lion's share, or I have to be the one that will take the loan. It has to be what? It has to be shared not equally, but on pro rata basis. Pro rata basis. So these are some of the requirements we look at in the second tier security market. Please, it's very important. The exams can ask you to list out this, requirement for admission into the security, into the second tier security market. Then we look at the advantages to the of the security, second tier security market to the investing public. You understand? We look at it, how it helps the investor to know the ability of the company, to know whether they are efficient, profitable, or maybe they are a business that they can invest on. They also give them the opportunity to get loan, and so on and so forth. So let's just go on to straight to our what we have today, capital. I believe the word capital, is not new. I believe it's not new, the meaning of capital. But when we talk about capital, different things will come to your mind, isn't it? We look at capital, when we are very young, even in our junior school days, we say whenever they measure capital, we look at state, because it's always state and capital. Lagos, Ikeja, you know all that. Yes, it's still capital, isn't it? The capital cities. So when we are not saying capital, you should know the point of the direction with which you are talking from. I believe we are together. All right. So capital, just like market, is also ambiguous. But when we are talking about capital, two people are very much concerned in business. We look at capital from the viewpoint of the accountant. You look at the capital from the viewpoint of the economist. You understand what I'm saying? So economists are what they define as capital. Accountants also have their own view about capital. You understand what I'm saying? So let's look at it one by one as we proceed. The accountant point of view of capital is this. Okay, accountants define capital as the funds or money used to start and maintain a business. I believe that one is clear. Accountant, that's their own view. The amount you use, the money you have used to start a business or to maintain a business, that's your capital. Let's say, okay, I want to start a business, okay. I want to open a shop, a bookshop now, for example, and I put 1 million into it. That is capital from the point of view of business. That is all capital. So capital is always synonymous to money or with money. That's it. Capital is in an accountant view is the owner's equity. That's it. The owner's equity is what we call capital. You understand? And when we talk about the share capital of a business, it is made up of two things: equity and debt. You understand? Don't let us go to that today. All right. So capital is always seen by the business person or by a business owner as what? As the amount invested in business. You understand? In finance, in business finance, let me keep in this. In business finance, we call that venture capital. Business finance, they define it better that, okay, venture capital is the amount we use to start business, because we keep talking about capital, 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 and everything becomes ambiguous. So we look at capital. So in business finance, we call it venture capital. It is venture capital because it is the amount you use to start business. You understand? All right. But what is the point of view of an economist? You know, their own is always different from the way accountants will see it. Let's look at it. Economists define capital as the man-made resource or wealth set aside for the production of more wealth. All right, that's how. Let's see how GM Keynes. I don't know if you have heard those words before. That name before rather. J.M. Keynes. Those are the founding fathers of economics. You understand? Founding fathers of economics. They give their own thoughts about the view of economy. So, and one of those things that they give their thought on is the word capital. So, now let's see. He says by a continuous process of inflation, government can confiscate secretly and unobserved an important part of the wealth of their nations or citizens. All right. Okay. Now, capital refers to the property of a firm used in the production of goods and services. So, to the economist, capital is one of the factors of production. That is just the view of the economist. That's it. You are not talking about capital as the only the money. How will we say capital is only the money? Are you with me? They are not saying that okay, capital is only the money. That's what accountant believes. Money and money what? But when you talk about the economy says, okay, see, capital is not only money, but capital include money. Capital include the properties. Capital include all those items that are man-made. You understand? That has a kind of derived demand. Those ones that you are not engaging them because of the satisfaction they will bring for themselves. You are engaging them because of what? The utility, the satisfaction that they will bring for the business of the production of goods and services. I believe you can see that. So accountant's view of capital is different as money. They used to start business as your what? Your assets less liabilities. That's another way to get your capital. Okay, your total assets, you remove your what? Your liability, you get your capital. Correct. But economics says no. The resource or all the items that are man-made, machine, computer, motor vehicles, all those things, they were what? They are man-made, used to do, a business, to start a business. But a layman, when we talk about layman, it's not someone that is illiterate. Get that point clear. A layman is talking about someone whose view is quite different. You understand that maybe he does not really know much about what you are talking about. For example, now in medicine, I'm a layman. Why? Because I don't know what they are talking about. When they are talking about their atom, they are talking about all their neutron and all that. They are just strange words to me. You understand? So I'm a layman. I believe you understand what I'm saying, and that does not mean I'm illiterate. And if you don't understand what they are saying in a particular field, for example, that does not mean you are illiterate. It only means that you are not in that field. So you may not be able to get what they're actually saying. So a layman says capital is the total amount of financial resources or money used to run a business. Or money used to run a business. Can you see? The amount you used to run a business. That is capital. All right. So today, let's quickly look at the types of capital, and in the next class, we do, a kind of a brief solution on capital. This topic is very important. In fact, there has never been any year where I could not bring question on it. There's never been any year never will not bring question on it. There's never been any year jam will not bring question on it. So you know it now, you know it all. You understand? It will come out in your account. In fact, that's what you will do more. It comes out in your economy. So once you're able to grab it now, you already have it in your default. All right. Authorized or nominal capital. Please get it clear. When we talk about authorized or nominal capital, this is the total amount of capital which a company is authorized to issue out for subscription, or is stated in the memorandum of association. Now, it's just like the amount that the business is using to start business. For example, how much did I need to start a petty trade? Let's say I want to be selling Indomie, I want to be selling biscuits, sweets, and all that. How much do I think I need? Maybe I want to be selling all this soap and all that. Let's say 50,000. That's my authorized capital. So the authorized capital of a company is the amount they have in their book, their memorandum of association, and is approved by the register of companies. Like, okay, this is your venture capital. I think that one is clear. Now, out of this authorized capital or nominal capital, they have another one we call issued capital. Please get it. Issued capital is always part of the authorized capital, just like say subset. You remember your set. We have set and we have the subset. So issued capital is a subset of authorized capital. You are going to take out of it and give it out, issue out for public subscription. For example, you remember we said 10% of the company's authorized capital should be issued out. This is the issue capital we're talking about. It depends on the company or on the floor where the company is listed. If it's on the stock exchange market, it has to be, it can be maybe 20%, but it's always stated that in anytime we want to issue our capital, we have 10,000 or 100,000 or 200,000 out of 1 million. Correct. The third one, called up capital. This is part of the issue capital that has actually been called up and the shareholders have been asked to pay for it. Now, assuming we are issuing out 500,000 shares, this called up capital means these are the ones that we have called the shareholders to pay for. Let's say we are issuing it out at par. That's 50 kobo at par. Okay, we ask the shareholders to issue to do or to pay for it. That is what we call the called up capital. Now, the paid up capital is the called up capital which shareholders have actually paid for. The called up is that we ask them to pay. The paid up is that they have now paid. I believe you can see the difference. All right. Called up is okay, you have to pay 50 kobo. Paid up now is that okay, when they are now paying, they're now paying 1 naira. What does that mean? It means they are actually paying at premium. I believe you understand. There are 3 ways by which shares can be of issuing shares: at par, at nominal, at par, at premium, and at discount. At par is the nominal value, 50 kobo or 1 naira. At discount means that maybe the share is not performing well. We now have to remove 50 kobo from it. That is called discount. But maybe people are buying and rushing. What do? We increase it. We now say it at 150 kobo. That is called at premium. All right, number 5. Uncalled capital is the part of the issued capital, share capital that has not been called up for payment. The ones that are the part that has not been called up, they are called out of 500, they are called only 300. The remaining 200 has not been called up. That one is called uncalled capital. All right. Okay, types of capital continue. Number 6. Capital employed. Your capital employed is simply your total asset. Please, you have to get this. It will help in your trading profit and loss account as well as your balance sheet. Your total asset has to do with your fixed asset and your current asset. You sum the two together, you minus your current liabilities. That gives you your capital employed. The capital owned, that is the worth of the whole of the business. That is the total asset minus total liabilities. Can you see the difference? Capital employed is always total asset minus current liabilities, while total asset, your capital owned is total asset minus total liabilities. Please don't confuse it because in a question you can see it so that you don't mix things up. All right. Fixed capital. This question came out in this year WAEC economics. The students were asking me, what they are. They asked us to explain fixed capital. And they asked us to explain working. I said, wow, all these things you have done it in your commerce. You understand? But your ability to recollect it is key. Fixed capital has to do with your what? All those durable capital. We call them fixed assets. That can last for a very long time. That is even expiration is more than 1 year. You understand? We talk about furniture, motor vehicle, and all that. Then working capital is also very important. Your working capital is always your current asset less your current liabilities. That is the excess of your current asset over your current liabilities. This will give you your working capital. My dear student, this is where we're going to stop. We're going to draw the curtain for today's class. I believe that in the next class, we're going to look at this simple solution, the solution to this calculation, and it will actually help us for it will also help improve you when you are doing your work, when you are doing your account. So see you again next time. Stay safe. Bye bye.